Welcome back to the deep dive. Today we're going to do something pretty critical. We're going to completely ignore the retail chatter, the headline sentiment.
Right.
Our mission is to apply a purely institutional framework, the kind of rigorous process senior PMs use, to really analyze the market's microstructure, its underlying fragility.
That's it. Because on the surface, things might look, neutral. But institutions, they don't trade on feelings. They trade on conviction. And that conviction shows up in volume.
So we're here to figure out if recent price action is genuine belief or something else.
Or if there are subtle signatures in the volume that point to very strategic risk-off strategies being deployed quietly under the surface.
Okay, we've broken this down into 4 key areas. First, reading that institutional footprint accumulation versus distribution.
Then a market health check, breadth and liquidity.
Third, we'll interrogate the fear gauges, the volatility markets, and finally the advanced playbook, options gamma and dark pool signatures.
And when you synthesize all the source material, a picture emerges pretty quickly. The environment beneath the headlines is, I'd say, profoundly nuanced and, well, potentially quite fragile.
Which would dictate a highly risk-managed approach right now.
Exactly.
All right, let's get into section 1. The biggest problem for any institution is size, right? How do you put $500 million to work without spiking the price against you?
It's all about stealth. It's almost always done in low liquidity periods, especially that last hour of trading.
So what are the specific signals? What does that quiet buying or accumulation actually look like on a chart?
You're looking for price consolidation in a really narrow range. So the price isn't moving much, but at the same time, the trading volume is ticking up noticeably. That's the institution covering its tracks, building a line of stock without pushing the price up too early.
And how do you know it's real accumulation and not just, temporary support? What's the final confirmation signal that they're done building and ready to go?
It's the breakout. When that stock or index finally breaks out of that tight range, it has to be on volume that is way higher than average. We look for, say, 2 to 3 times the normal daily volume.
And near the close.
Crucially, near the close. That confirms their work is done, the position is built, and now they're applying real, genuine pressure.
Okay, so let's flip that. Institutional selling distribution. This is often harder to spot because it can happen into strength, right?
Much harder. You're looking for a divergence. So you see price stagnating or even ticking down a little after a strong rally. But the volume near the close is huge, surging.
So if the price isn't making new highs, but the volume is massive.
That supply is clearly reading demand. It means institutions are successfully selling into the enthusiasm of the crowd.
That sounds like what people call a churning market. A lot of activity, but no real progress.
That's exactly what churning is. It's a classic sign of distribution. Another huge tell is the accumulation distribution line, the AD line.
Explain that one.
It's a simple indicator that tracks the relationship between price changes and volume. If that AD line is trending down, even while the index itself is just chopping sideways or maybe even slightly up,
I see.
It confirms that underneath the surface, selling pressure is quietly overpowering the buying. The quality of the move is just deteriorating.
When we talk about conviction, it always seems to come back to that relationship between price and volume. So why is rising price on declining volume such a major red flag for portfolio managers?
Because it tells you the base of support for the move is shrinking, it's getting smaller. A real healthy uptrend needs broad participation. It needs enthusiasm. Volume confirms that.
Right.
So if you see the price going up, but volume is falling off, that momentum is being fueled by fewer and fewer people. It could just be late to the party momentum chasers or short covering. It's a signal that the big institutional money is already stepping away.
Market's running on fumes.
It's running on fumes, and a reversal is probably coming. And the opposite is true, too, a falling market on rising volume. That confirms the panic is real, and the conviction to the downside is strong.
That's a vital distinction. Let's transition to our institutional health check. Section 2, starting with market breadth. We all know the indices have held up, but our sources are emphatic that this rally has been narrow.
Dangerously narrow. You look at the raw data, things like the advancers versus decliners ratios, they're consistently struggling to stay above 1-to-1.
So for every stock going up, there's another going down.
Basically, you might have, say, 10 megacap stocks pulling the S&P 500 higher, but the other 490 are flat or even actively declining.
So an equal-weighted version of the index would tell a much, much weaker story.
A far more bearish picture, absolutely. And this leadership by a few, which is almost all in megacap tech and growth, it creates this profound systemic risk.
How so?
Well, think about it. If those few leaders falter, maybe because of an earnings miss from just 2 or 3 names, there's no broad market strength to cushion the blow. The downside could be completely outsized relative to the actual news.
And that narrowness is coupled with another concern flagged in the sources. Liquidity strain. Not a big freeze, but degradation. Where are we seeing that?
It's in the small stuff, the things you only see if you're executing large orders. Bid-ask spreads have been subtly widening, especially in less liquid areas like small-cap stocks or certain parts of the fixed income market.
So it's just getting more expensive to transact.
Your transaction cost goes up and your price impact is greater. It just implies there's less depth, less immediacy in the market.
And that ties directly back to the behavior of the primary dealers, right? The system's shock absorbers.
It does. Our sources are indicating there's a reduced willingness among those dealers to warehouse risk, to hold big inventories. That makes the market functionally thinner. If a big fund needs to sell and the dealer doesn't want to take on the other side,
The price has to drop much faster to find a buyer.
exactly. We track this with metrics like the Amihud Illiquidity Ratio.
So for anyone who's not familiar, what does the Amihud ratio tell us right now?
In short, it measures the price impact of a given amount of trading volume. A high Amihud ratio means you're seeing big price changes on relatively low volume. And in a market where dealers are backing away, a rising Amihud is a big warning sign.
A sign that it's getting harder and more expensive to move capital without triggering a major market reaction.
Which is the definition of structural fragility.
Let's shift gears. Section 3. Let's look at the expectation of fear. And we're moving beyond just the spot price of the VIX, the so-called fear index, to the term structure, the curve. Why is the shape so much more important?
Because the shape tells you what the market expects volatility to be in the future. The normal, healthy state is what we call contango.
Where futures further out in time are more expensive.
Correct. It suggests people think any current volatility is temporary. The opposite is backwardation near-term panic. But the real caution right now is coming from a flattening of that curve.
A dangerous middle ground.
Very. Our sources note the VIX curve has flattened noticeably, especially in the front 2 months. This isn't full-blown panic, not yet, but it's a critical psychological shift. It means participants are pricing in a much higher chance of a near-term volatility spike.
So confidence in the market's ability to absorb shocks is falling.
It has eroded, yes. And this isn't just a broad market thing. Look at the tech sector.
The VXN.
The VXN, the NASDAQ 100's volatility index, is showing an even more pronounced flattening. And since the NASDAQ leaders are the very same stocks driving this narrow rally,
It suggests the market is deeply skeptical that this tech-led momentum can last. The cost of ensuring those leaders is rising fast.
exactly. And to compound the problem for asset allocators, we're seeing these widespread correlation breakdowns. The whole 60-40 portfolio was built on the idea that when stocks fall, bonds rise, they hedge each other.
But that hedge is disappearing when you need it most.
It is. We're seeing more and more instances where defensive sectors don't work in a pullback, or worse, where equities and bonds just sell off together, in tandem. The diversification benefit is eroding right in front of our eyes.
That's a massive structural problem. How do you defend a portfolio when your defensive assets move in lockstep with your risk assets?
It forces a total strategic rethink. And you have to watch the credit markets here. They're the canary in the coal mine. We've seen credit spreads, high yield over investment grades start to widen even while equities are stable.
The bond market is getting nervous.
The bond market is signaling skepticism about corporate health, about recession risk. It's a skepticism that the equity market often ignores until it's too late.
Okay, let's move to the advanced playbook, section 4. Here we're hunting for setups with asymmetric risk-reward. A potential 3-to-1 payout. And to find that, you have to understand the mechanical forces at play. You have to understand options gamma.
Gamma is everything for short-term moves. It's the rate of change of an options delta. But what really matters for you, for the listener, is the aggregate gamma positioning of the market makers, the dealers. Their positioning dictates how they are forced to hedge.
Okay, so let's clarify that. If the market is in what's called a positive gamma environment, what does the dealer have to do?
Positive gamma is stabilizing. If dealers are net long gamma, they are forced to trade against the market's direction to stay hedged. So if the market rallies, they sell the underlying stock. If the market dips, they buy it.
Creating a stabilizing feedback loop, dampening volatility.
Exactly. It often pins the market around major option strike prices, especially heading into a Friday expiry. It's like a gravitational force.
But if that flips to a negative gamma environment,
The source completely reverses.
yeah,
Now the dealers are short gamma. So when the market rallies, they're forced to buy more. When the market dips, they're forced to sell more.
an amplifying feedback loop.
A highly dangerous amplifying loop that just accelerates price moves. It leads to those aggressive, fast trends. That's why the price level where that flip happens, the gamma flip level, is maybe the single most important number for a short-term risk manager.
And we track these huge concentration points, these gamma walls, that act as major support or resistance. So how do we tie this mechanical flow back to what the big long-term institutions are doing?
For that, you have to look at the dark pool signatures. These are the off-exchange venues where institutions trade huge blocks without tipping their hand. And our analysis shows a very persistent pattern that confirms all the caution we've been talking about.
What's the signature of de-risking?
In those high-flying market leaders, the ones driving the index, we are seeing large block trades executing consistently near the bid price.
So they're hitting the bid. They are the aggressor in the sale.
They are actively selling with size, but quietly, to minimize the impact. It is discrete distribution.
And on the other side of that trade, where's that capital going?
We're seeing quiet accumulation in defensive sectors, in value-oriented names, and those trades are often happening near the offer price. They are lifting the offer, building their positions.
So the dark pools confirm a strategic reallocation, de-risking from the fragile leaders and building positions in more durable areas.
The synthesis is powerful. It reinforces the cautious narrative that we're already seeing from the VIX curve and the market breadth data.
You know, that's an incredible deep dive into the data. The confluence here, you've got incredibly narrow market breadth, falling VIX complacency from that flattening curve, eroding diversification, and then the strategic repositioning confirmed in the dark pools. It really does suggest fragility, even if the daily price looks fine.
I think the key takeaway for you listening is that the market's ability to absorb a shock seems diminished, and that structural dependence on just a handful of names, it creates the perfect setup for asymmetric risk.
Where a small negative catalyst can trigger a disproportionately large reaction. So let's apply this framework. Let's look ahead to something like a major options expiry. If we imagine a big S&P put wall at, say, 5350 acting as support, and a call wall at 5475 as resistance, where's the asymmetric trade?
Well, if we're in a positive gamma environment, the market will probably just get pinned between those levels. The asymmetry isn't in the pin, it's in the break.
Oh,
If the price slips just below that 3,350 put wall, that's where stop-loss orders are clustered. And that trigger can be enough to flip the entire market into a negative gamma environment, forcing dealers to suddenly accelerate the sell-off.
because they are now forced to sell into the dip.
That is the definition of asymmetry. You're anticipating a mechanical reaction that is far larger than the fundamental catalyst simply because you understand the structure of the market.
That structural insight is what separates conviction from just sentiment.
It's everything.
We started today by looking past the headlines, and what we found is a market that seems structurally dependent and is already strategically repositioning. So to leave you with a final thought to mull over,
Given this structure, the narrow leadership, the flattening VIX curve, what is the true systemic risk when traditionally uncorrelated assets like high-grade bonds and equities keep moving in lockstep during stress? And how does a modern portfolio manager actually diversify in an environment that's fragmented?
think about that structural fragmentation. We'll catch you on the next deep dive.